And economic policy uncertainty. This is the ideal environment for gold to thrive. How the world prepares for war and its market impact. Nations prepare for conflict in ways that directly impact the global economy. Increased government spending, massive spending on defense, energy security, and aid. This often leads to higher national debts, sanctions and trade wars, disruptions to global supply chains for key commodities, like oil from Russia, leading to inflation. Currency weaponization. Using the US dollar as a tool of foreign policy, e.g., freezing assets, makes other countries nervous about holding dollars. They may diversify into other assets, including gold. Market volatility. Stock markets hate uncertainty. Investors flee risky assets, stocks, for safe ones, bonds, gold, certain currencies. Gold's role is to act as a stable store of value when these forces erode the value of paper currencies and other financial assets. How to take advantage with gold as a refuge asset. The goal isn't to speculate wildly, but to protect your wealth and potentially profit from a major trend. Here's a strategic approach. 1. Direct physical ownership, the purest safe haven. What it is: buying physical gold bars or coins and storing them in a safe or a secure vault. Advantage: it is the ultimate insurance. It's completely outside the financial system. If there were a banking crisis or cyber attack, you still have your wealth. Disadvantage: storage and insurance costs. Less liquid than electronic forms. How to prepare. Allocate a small percentage, 5 to 10%, of your portfolio to physical gold. Buy from reputable dealers. 2. Gold ETFs, the easy and liquid way. What it is: exchange-traded funds that track the price of gold. Each share you buy represents a portion of physical gold held by the fund. Examples: GLD, the largest and most popular; IAU, lower fees; FIZ, Canadian, redeemable for physical. Advantage: extremely easy to buy and sell through any brokerage account. Highly liquid, no storage worries. Disadvantage: you don't own the physical metal itself, it's a financial instrument. How to prepare. This is the most common way for investors to get exposure. It's perfect for reacting quickly to news events like those in your screenshot. 3. Gold mining stocks, leveraged play. What it is: buying shares of companies that mine gold. Examples: Newmont Corporation, NEM, Barrick Gold, Gold. Advantage: they offer leverage to the gold price. If gold goes up 10%, a well-run miner's profits might go up 20% or more, and its stock often follows. They can also pay dividends. Disadvantage: higher risk. You are exposed to company-specific risks, bad management, mining accidents, local politics, and general stock market volatility. They can fall even if the gold price is stable. How to prepare. Allocate a portion of your risk portfolio to a diversified basket of miners or a miner ETF like GDX, major miners, or GDXJ, junior miners. 4. Gold futures and options, for advanced traders only. What it is: complex derivatives that allow you to bet on the future price of gold with significant leverage. Advantage: huge potential returns from a small amount of capital. Disadvantage: extremely high risk. You can lose your entire investment very quickly. Not for wealth preservation, for speculation. How to prepare. Unless you are a seasoned professional, it's best to avoid this route based on geopolitical headlines. A practical preparation plan. Educate yourself. Understand the different ways to own gold, as above. Determine your allocation. Decide what percentage of your investment portfolio you want in gold as a permanent hedge, e.g., 5 to 10%. You might increase this slightly if you believe a major crisis is imminent. Choose your vehicle. For most people, a combination is best. Core holding: a gold ETF like GLD or IAU for liquidity. Insurance holding: some physical gold in a safe for worst-case scenarios. Growth satellite: a small allocation to a gold miner ETF like GDX for potential outperformance. Execute and hold: buy your chosen assets. The key with a safe haven asset is to hold it through the volatility. It might sit dormant for months and then spike dramatically on a news event, like the ones in your screenshot. Monitor the triggers. Keep an eye on the news feeds for escalating war, conflict, major new sanctions or trade wars, signs of banking stress, the Federal Reserve signaling a pause or cut in interest rates. This is a huge driver for gold. Conclusion: the world in your screenshot is a world on edge. The headlines are a textbook recipe for the fear and uncertainty that drive investors to gold. By allocating a portion of your wealth to gold now, you are not betting on war. You are insuring your portfolio against the economic consequences of extreme uncertainty. It's a prudent defensive move, not an aggressive speculative one.